Getting a low interest rate is crucial. In this video, I'm going to give you tips you can use to get the lowest interest rate possible in a very difficult market. Locking in your interest rate is one of the most important things you can do when getting a mortgage. But why is that and how does it work exactly? What we're experiencing right now in the current market is interest rates are fluctuating at a rapid pace. One day interest rates will be 7.5% and maybe in a week or two, 7%. When you lock in your interest rate, which is called a rate lock, you're guaranteed a particular interest rate for a set amount of time. To lock in your rate, you'll talk with your lender. It can be a little tricky because what you'll learn about lenders is anything you try to do, there's a price for it. You'll want to ask your lender, how much will it cost to lock in your interest rate and what are the terms of your rate lock? Typically, you lock in your rate and then it's locked in for a certain amount of time. Now, if something happens where you're not able to find a home that you want to purchase within that time, or let's say you're under contract and the closing date is moved back and your interest rate lock is going to expire, that would be an issue. You want to find out exactly what are the terms for a rate lock from your lender. Also, what I recommend, and I'll go into this a little bit more in detail later, is shopping around for lenders because each lender is going to be a little different and can offer you different terms. Asking a lot of questions about the rate lock and the terms of it are critical to make sure you don't end up overspending or not being able to lock in the lowest interest rate possible. Another way to lower your interest rate is to get a loan level price adjustment waiver. I won't go into too many details about this because there are a lot of variables, but basically what this means is when you're borrowing from a bank that's associated with a federal loan company, they may add fees depending on how risky of a borrower you are. If you make the average median income or lower in the area that you're buying, you could qualify for a waiver, which could save you anywhere from 0.25% to around 1% on your interest rate. Ask your lender about the average median income level price adjustment waiver, or AMI LLPA. It just rolls off the tongue, doesn't it? Your lender can tell you if that's something you might qualify for. Now let's get into shopping around for lenders. Just like anything you do in life, you should have multiple options, and a lender is no different. Sometimes people will choose to just get a home loan from their banking institution, which is totally fine. I think that's a great option because you are a current customer. They may give you a lower interest rate or certain deals, maybe like a free rate lock or a discounted loan origination fee, something like that. But you'll also want to interview a few other lenders. I recommend about 3 lenders. What you're trying to find out is what are their terms, how much the loan origination fee is, what kind of rates they can find you, different loan programs that you might qualify for, things like that. Another way to get a low interest rate is focusing on buying new construction homes. These are homes that are in a new construction community. What I found is that new construction communities want to make sure that they sell their homes, and they know that high interest rates are a major barrier now for people to get a loan and buy a home. Some builders are offering lower interest rates. Now you might ask, how are they able to do that? Typically, the way that it works is you have to go through their preferred lender. What that means is usually the builder owns a mortgage company or they have some sort of relationship with the mortgage company where they can offer you a lower interest rate. Now, like any loan you're going to get, you want to make sure you look through the terms of the loan, especially with these kinds of loans because sometimes there can be different hidden fees and things like that. You want to ask a lot of questions and get a good understanding of the loan product you're getting. Now, like any loan you're going to get, you want to make sure you look through the terms of the loan, especially with these kinds of loans because there can be some different fees and things like that. Ask a lot of questions and get a good understanding of the loan product that you're getting, especially if you're getting it from a builder's preferred lender. It's also important to note here that I have heard that some lenders are kind of backing away from giving interest rate deals. So by the time you watch this video, this may not be a thing that happens anymore. But you never know, it doesn't hurt to try. Are you ready to take the next step towards becoming a homeowner? Go to workwithdanG.com and let me be your guide. I'll set you up with a trusted real estate agent, a free homebuyers course, and share some resources like an affordability calculator. Let's make your dream of becoming a homeowner a reality. You can get a 3% interest rate. Now that's something you might have been hearing recently, but it's a little tricky. Typically what someone is talking about when they're saying a 3% interest rate or lower, it's an assumable mortgage. An assumable mortgage is when you take over the loan payments from a seller. The way this works is someone bought a home with a mortgage. The mortgage has to be assumable, which means it can be passed along to someone else. you will have the same terms that the original borrower does. As an example, someone who got a loan in 2021 or 2020, whatever, they might have a 3% loan or even lower. With an assumable mortgage, you would take over that loan, so you would have that lower interest rate. Now, the caveat to that is sometimes this isn't explained very well, that you will be getting a mortgage for the balance that they owe. Let's say the balance that they owe is $250,000, but you're buying the home for $400,000. Well, you would need to come up with the rest of the money for the home. This is done by either being fortunate enough to have the cash for the difference, which would be awesome, or you end up getting a second loan, 7%, 6%, whatever the going rates for loans are at that time. In this way, you're still saving money because a portion of your loan will be at a lower interest rate. Now, there are a few negatives to this strategy. A couple of them real quick are assumable mortgages typically take longer to close than a normal home loan, taking up to about 90 days, sometimes less, sometimes more. If you're in a market where it's considered a seller's market, a seller may not want to wait that long for the loan to close. But there are some sellers who don't mind longer closings. Another issue is you're applying for 2 loans at the same time. You're juggling a couple of different things at the same time, so there's a little bit more moving parts than just buying a home with one loan. Another way to get a low interest rate is by working on your credit score. Some people really focus on making sure that they have the highest credit score possible. You definitely want a good score, but it doesn't have to be perfect. What I mean by that is typically if you have a FICO credit score of 780 or more, you'll get the best terms on a loan. Now, there are a few other factors that are in there other than just having a good credit score, like debt to income ratio and things like that. But I do like to make sure that my clients know that are trying to improve their credit score, you don't need to stress out thinking you need a perfect 850 or anything like that. At that point, it's more of a vanity number than a number that's actually going to get you better terms on your loan, aka a low interest rate. Another strategy you may have heard before is buying mortgage points. Mortgage points are a way that you can lower your interest rate. Typically, if you buy 1 point, then the interest rate goes down 0.25%. This could vary depending on your lender, but that's the usual term that I'm familiar with. Before buying mortgage points, what I would recommend looking into is putting down a larger down payment, because it's possible that in the long run, you might save more money by just getting a lower loan amount than actually paying for mortgage points. That's something that you can have your lender crunch the numbers for you, or you could even do it yourself. But just proceed with caution with mortgage points because it's not always your best bet. However, there are situations where that's definitely something to look into. If any of these tips helped you, please like and comment to let me know. Thank you for watching this video to the end.